Hey YouTubers out there, welcome to the Kevin Strong Show, and in this video we're going to talk about, are you high on credit cards? Just kidding, but we are going to talk about credit cards. I'm going to go over some information that I think is very important. Once again, this channel is all about topics you can trust, and I try to get away from the fluff and give it to you straight. So I want to go over some information. Some people really don't understand the primary purpose of a credit card. Now, in my humble opinion, the only time you should be using credit is that if you're trying to use it as a vehicle to beat inflation and or accumulate wealth. So what would be an example of using credit? Not a credit card, but credit that would accumulate wealth and beat inflation, right? Real estate, for an example, right? You can probably get a better rate of return on your investment if you're borrowing money to acquire a physical asset like real estate in relationship to what you have to pay the interest rate back at, right? So let's say you have investment property and they're charging you 5% on X amount of dollars, and with your rent and after all the expenses, you're seeing a positive net flow, and that's what cash flow is all about. After all my expenses are paid, to include my debt, how much money do I have left over? It's called positive cash flow. The other side, more importantly, as it relates to credit cards, is that people who brag about using credit cards that pay them off on a monthly basis talk about the cashback incentives, right? The mileage programs, things like that, other perks that come with certain credit cards, but you really only benefit from those if you pay your credit card balance off every month. Now, approximately 34% of Americans pay their credit card off each month. So that leaves about over 65% of Americans are carrying a balance from month to month. And the average credit card interest rate is around 16%. Now, some of you who have been watching the news are keenly aware that the Fed is getting ready to hike interest rates. Mortgage rates are starting to tick up. And as a result of that, other consumer debt that's tied to the interest rates, without getting technical, you're going to see those go up. So the interest rates that are associated with your credit card debt is going to go up, and it could go up quite a bit. So we're going to talk about some things to avoid and some of the pitfalls that are associated with credit cards. So the first one we're going to talk about, they can damage your credit score. Your credit score determines a lot more than what your interest rate could be on your mortgage. A lot of times your credit score as it relates to credit cards can actually, let me back that up. Let me slow my roll a little bit. Slow down. I'm not even going to edit this. We're just going to go with it, baby. What I'm trying to say is that if you misuse credit cards, it can have an adverse effect on your credit score. And things even like your insurance sometimes is determined by your credit score. And even apartment complexes use that as a key criteria before they offer you a place. And if you know as well as I do, whether you're local or national, rent is going up. It's getting more competitive and even harder to find a place to live. So it's important to keep your credit score up, and a credit card could have a negative impact on that indirectly. Second point I wanted to talk about is they can come with universal default. Now listen to this one real carefully, guys. Universal default basically states that if you make a financial mistake somewhere and it gets into your credit history, then the credit card company has the right to raise your interest rate to the highest rate possible. So this can be something as a garbage bill or a cell phone, because cell phone companies typically don't report to the credit card companies, right? But if you go into default or go into collections, that activity will appear on your credit report. And as a result of that, the credit card companies can find out about that. And in the fine print, they can use that as an accelerant clause to raise your credit card rate even higher. That was like raising the roof a little bit. That's what happens when you listen to R&B before you do some of these videos. But anyway, we're gonna keep this moving on here. They change huge interest rates. I think I just kind of talked about that. So when you get a fixed rate on your credit card, it may be fixed, but it's subject to change at the credit card company's discretion. Typically, they have to give you anywhere from 2 weeks to a 30-day notice that the interest rate on your credit card is changing, but that does happen quite often. Credit cards, as you know, they come with numerous fees. While credit card companies make a lot of money on interest, they almost make equally, if not more, from fees, late fees, going over your credit limit, things of that nature. So you really, really want to watch out for that. It's also important that you probably have some kind of alert set up either by way of email or text message, or if you get within like 10 or 20% of your balance or your available credit limit, you want some kind of notification so you don't get hit with some of these fees. And you have to read the fine print because there's a lot of hidden messages inside of the fine print as it applies to a credit card. For example, that fixed interest rate card that you will assume that will stay fixed forever may not. And that's what I just talked about earlier. The fine print will reveal that it's only fixed at that rate until the company gives you a 2-week notice. This is what I talked about. So you have to be careful because most of the times people really don't look at the fine print. They just see what the interest rate is, and then they fill out the card and they just make their monthly payments. I would respectfully submit to you guys, I bet probably 80 to 90% of Americans who have credit cards, even those individuals who pay the credit card debt off every month, does not know how to back out of that credit card statement and calculate their own minimum payment to make sure that the payment that the credit card company is sending you is actually the right amount of money. So you'd be surprised how many people do not know how to do that. They have deceiving minimum payments, and that's why it's important for you to learn how to calculate what your minimum payment should be based on your balance. Okay? When a credit card bill comes and only a very small payment is needed, many assume that this means that overspending isn't that bad. This small amount, however, will cost you a lot of money in the long run. Credit cards set the minimum payments low to extend the loan as long as possible. So some people are comfortable making the minimum payment and they're not really fixated on the overall balance that's associated with that card, and equally, if not more important, how much is the interest on that available balance that I'm carrying every month that I cannot pay it off in full. We all know that credit cards encourage you to do what's called impulsive spending. You're less likely to do that with cash because obviously you're limited, but if you don't see it, it doesn't exist. That's the whole purpose behind the psychology of credit cards for those who don't have the discipline to know that the purpose of that, if you are going to use it, is to pay it off every month. And if you can't do that, I would say at least within 60 days, you're really telling yourself that you're purchasing something that you just simply cannot afford. And last but not least, we're going to talk about credit cards that will do the bait and switch on you. When you receive that pre-approved zero fixed rate card application in the mail, you assume that when you fill out all of the information that you will receive a 0% credit card, because that's what the application or that's what the invite said when you opened up the mail. But once again, the fine print says, the fine print that you don't read, you agree to take whatever interest rate that they give you at the time that you get approved. So they have the discretion to give you a different interest rate from what the advertising or the marketing letter said based on your credit score and some other factors. And typically if you call to say, hey, I have a certain score, why didn't I qualify for the 0%, which is probably, let's say, excellent credits like 750 or something like that, they're going to give you some salesman pitch as to why you didn't get the card that you needed. So if you don't need the card and you are purely applying for the 0% and you don't need it, don't activate the card, call the company back and cancel it. Because typically it has to be activated and you have to use it before it becomes a part of your credit profile. So just wanted to quickly jump out and give you this information about credit cards. I don't normally tell my clients to use those things. Like I said, if you can't pay it off within 30 days, ideally no later than 60 days, then you probably don't have an adequate emergency fund, and you probably shouldn't be putting goods and services on credit. If you have to do that from a survival standpoint, that's totally understandable. But if at all possible, please stay away from credit cards unless you can use them responsibly. It's like drinking, right? So I'm going to wrap this up, guys. As you know, keep your credit scores up. Keep your debt down before your debt gets a hold of you. I hope you enjoyed this content. Please comment and share because I care, and I hope you do too. And please subscribe to The Kevin Strong Show, and I'll see you in the next video.